So once again, in the March quarter, we've seen really strong equity markets, and that's just been highlighted by that continuation of the expansion theme, people coming out through COVID, looking through that and seeing economies reopen. We've seen, particularly in developed economies, the IMF have upgraded growth forecasts there, so that positivity and optimism has been reflected in markets. It's an interesting quarter because we've basically seen 12 months since COVID happened. So if you think of March quarter last year as the advent of COVID, and then fast forward that's 12 months. So we're seeing some amazing 12-month return numbers, but let's keep in mind that we started that 12-month period at almost all-time lows. Offsetting the strength in equities markets was weakness in bond markets. So as people have looked through COVID, they're now starting to think about other things, and one of the themes entering markets is overheating. We've seen an enormous amount of stimulus being produced by central banks. Obviously, the Biden administration has announced some extremely large fiscal measures, both in terms of that $1,400 check that Americans are getting, as well as the $2 trillion infrastructure plan that's just been recently announced. So markets are now concerned about inflation. You've seen that in the tick up in bond yields. So the US 10-year started the year at about 0.9%, it's now at 1.7%. What that does is it causes bond markets to deliver negative capital returns as bond prices adjust for that higher yield. So over the March quarter, we saw negative returns in bond markets. In the Australian bond market, it was about -3 to 4%, and similarly in global markets. So that's something that we need to be aware of, and something that we need to factor in portfolios. Oh, absolutely. The Biden presidency has now started to fulfill some of those mandates that you could say that they had as part of being elected. And so the enormous fiscal stimulus, I mean, you compare what the US is doing to anywhere else in the world, and they are absolutely committed to stimulating the economy back. And you're seeing this in a real rotation. This has been a theme right through the December quarter and this quarter, is as more confidence has been building in markets, you've seen that rotation into more cyclically sensitive parts of the stock market, and that's obviously financials, energy and industrials. And so that outperformance of those types of stocks, whilst arguably not as stark as we saw last year in terms of the tech stocks and the growth stocks, you are now starting to see that shift. And in the last quarter, I think it was about a 9% difference between returns on value stocks versus growth stocks. Yeah, the RBA is committed to keeping cash rates low. And so we've seen successive months now where the RBA has held the cash rate at 0.1%. This is all in an effort to continue to stimulate the economy in terms of that monetary policy setting. And they're not looking to move that anytime soon. And I think most of the concerns are around current levels of unemployment in particular sectors of the economy. So those sectors of the economy that have been impacted by COVID, the interesting thing is just most recently the RBA and central government released figures on joblessness, and it's actually not markedly different. I think there's increased unemployment by 0.6% over the period, and actual wages have increased 1%. So I think that's been a surprise to everyone. The IMF has also upgraded Australia's growth up to 4.5% of GDP this year. So it's a really strong story. The thing that's not factored into that is the JobKeeper tailing off. And so it is and has been reported that we'll see an uptick in terms of unemployment, in terms of number of jobs upwards of 150,000 jobs to be lost, for example, by some reporters. And you should start to see more companies in distress as that sort of fiscal stimulus is withdrawn from the economy. The IMF have upgraded growth forecasts around the developed economies, and so that's been really positive and really strong for markets. But the IMF has also downgraded developing economies, and so you might continue to see some concerns and some issues around developing economies, particularly economies that don't have as good access to vaccines or have the potential for COVID to be sort of a elongated type period. And I think we fully expect that. The issue is that as that is getting longer and longer, there are just those more risks of variants and COVID being endemic as opposed to a pandemic, so it just becomes part of our everyday lives, that risk increases. One of the things that's back on the agenda now is climate change, and so there's a lot of talk about climate change and the risks to global economies from that, and we've seen the flooding and weather events here in Australia. The other side of things is that deterioration or continued deterioration in the US-China relationship. I think when Biden came in, there was some speculation around what would happen, and if anything, things have gotten more tense, not less, as evidenced by recent talks, trade talks with China. So that will continue to be out there as a concern in markets. There's always various geopolitical concerns. However, from that reopening theme, things are looking pretty positive, in particular for equities markets. Taking action relative to market movements, though, is not something we generally do. And I was just looking at the 12-month returns as at March of last year versus the 12-month returns as at March of this year. And it's not so much the 12-month returns, but the impact on the 3-year and 5-year that's really important. At March 2020, the negative return that we experienced in that March quarter actually wiped out your returns for the 3-year and 5-year time horizons on equities markets. Had you pulled out of the market and then not been invested to get that uptick, we look at 3-year and 5-year returns now and they're around the 9% mark for 5 years, whereas at March last year it was 1%. So that impact of missing that year or even missing parts of that year can be exceptionally damaging to your portfolio as well. So managing through retirement and staying invested is really important. One of the aspects that we're talking to clients, particularly as we face into perhaps higher inflation, is what do we do on the fixed income side, where it might be increasingly difficult to generate real returns or returns in excess of inflation. So we have been taking some more tilts towards growth assets broadly across our client base and talking to clients about what that means and whether or not they can accept that higher level of risk. The other side of things is with fixed income and equities, what else can you invest in? And alternatives is a source of returns that we've always looked at, and we spend a lot of time looking in that area to find alternative sources of return that aren't necessarily reliant on cash rates and on equity markets. So broadening out your portfolio, managing your transition retirement, taking diversification and ensuring there's protection in your portfolio is really important. And it's a really significant part of our planning process with our clients.